Luke Downey, thanks so much for joining us on Wall Street Unplugged again.
Good to speak with you, Frank. I appreciate it.
Well, last time we had you on a few months ago, and guys, Luke has been writing for Curzio Research for months now, so free. You can look at it at Curzio Research, a website. I love it because you give readers a different perspective, almost purely from technical side, quant side. And I'm hoping that you've been paying attention because, Luke, you made some pretty remarkable calls on the way up and also a few days before the market came down. I want to talk a little bit about that because our investors are always looking for an edge. I always tell them you have to be open to all kinds of strategies, fundamental, technical, quant, whatever it is. But it seems like your system is working right now. Could you explain how you were able to see, especially recently, I think it was the 5th or so, that your signals are saying, hey, you know what, this market is overvalued right now, and we're expecting it to pull back. And a couple days later, less than 5 days later, we did see a meaningful pullback. Explain that system. What's helping you, look at the markets and be able to predict the markets like you have over the past few months?
Yeah, I think it makes a lot of sense to just do a brief little overview of what we do, and it's very simple. We follow the big money. That is our niche, and basically, what we try and do is we're looking at all stocks that are exchange traded. We're looking at ETFs as well. And then we're trying to track where the money is going. And every now and then, just like last time whenever we were speaking in March and the world was coming unglued, you see these extreme points. And so what you're referring to is a piece that I wrote for Curzio Research where we had saw this explosion in what looked like ETF buying. And what's so cool about that, you can see that from a data perspective. Forgetting the headlines, everything else, just look at cold, hard data. We could then circle back to prior times that were similar. And so there were 2 prior times that we all can remember. And that was January of 2020. I mean, the world couldn't get any more bullish in January of 2020. The same thing happened in January of 2018. And there was this huge flood of money that appeared to be going into all these equity ETFs. Usually that's mom and pop. Usually, they're the last in and first out. And so it made a very easy call based on data, not based on feel or anything like that, to say, you know what? There's a very high probability based on data that we're going to have a pullback.
So when you look at these signals, is it just ETF buy, like you said, mom and pop ETF buy? Because I have access to a lot of this stuff that, I pay a lot of money for, and Bank of America comes out with a report, trillions of dollars that it tracks. But they also break it down like retail investors, institutions, and hedge funds, where hedge funds have been steadily taking their money out of this market, less equities. Do you look at individual flow, or is it just overall flow into ETFs, which, again, that includes government buying ETFs and everything going into there?
Yeah, so it's literally looking across the board, and we're not looking at single names. I mean, obviously we get signals on the single names, but really it's trying to figure out, is a narrative changing? So what you see in our research is that money continues to flow in a certain direction, kind of like a wave, and it stays that way for a while, and it's pretty boring, to be honest with you. I mean, when money's going into the market, typically that can last for many weeks, many months. Similarly to what happened in the tail end of March, where we got really bullish based on data that was similar to this. Selling was just off the charts, right? Whenever there's big selling in ETFs, it's usually a good buy signal. And from that point, whenever we got that oversold signal, you started to see sellers start to evaporate. And then you had all this buying pressure meet all of that selling demand. And then all of a sudden we kind of took off for the races. And, there was basically a foot on the gas pedal practically all the way up until June 5th, or whenever we wrote that report, because there are these points that look like there's forced buying. Now, can't prove it. I can just use my analysis and our data to look back, but forced buying could be FOMO. Sometimes FOMO is so strong that people have to go buy. The other thing could be that people are just wrong way on this market, and they're wrong way in a big way, and so they have to cover, whether it's they get a tap on the shoulder from their risk manager that says, look, we got to blow out by the end of the day, whatever it is, whatever we're looking at, whatever we're measuring, it looks very similar. And it is almost always days before we see this huge buying, this huge flood of money, days before we have a beautiful pullback. And basically we had one on Thursday where, markets on average, I think, fell about 6% in a day.
Yeah, I mean, amazing, right? I mean, we talk about 6% market pullbacks would be a big deal, but it didn't even seem like it was that big of a, it just reminded everyone of the market conditions we're in, but it's just funny how something like that would have been catastrophic if it was a different time period. Now it's, with the volatility, it's pretty crazy. And that's going to lead to my next question, where you always want to pinpoint and get it close to someone that's been, following these games for such a long time, most of your career, and you've done so much in the institutional world that you're very familiar with the money flow coming in from, big money, right? Institutions. But how do you narrow it down? Because I was looking at gauges on a technical levels where, whatever it is, a new highs outpacing new lows, put call ratio, breadth of market, but a lot of these were signaling that it was still a strong buy, the market. So how do you gauge to when you're seeing investors come into the market and you're seeing this big, because you're using it as a contrarian indicator, right? So the more buying you see, it gets to extreme level, it's ready to sell. How do you know when it gets to the extreme level? Because we've seen buying. I felt like these were kind of at extremes weeks ago, but yet the market moved up considerably before falling 6%. And that's a tough question. I'm just curious if there's a way to pinpoint it where you get more accurate from it.
I get calls about this all the time, whether it's an RIA that consumes our research or it's a hedge fund that consumes our research. The way I like to think about it is we think about the analogy of a wave. And waves are different, right? So if you're going to surf a wave, you're probably going to surf a little bit different if the wave is 8 foot tall versus one that's 40 foot tall. Now, the wave of buying that we've been seeing the past month is a 40-foot wave, right? And so what we try to do is follow that money. Don't predict exactly what day that it's going to stop, but ultimately start to see when does the velocity of buying start to slow. And we've gotten better at that as time goes on because we now have captured so much data, and we have we've got data going back, to 1990. And that's really what it is. So what you don't want to do is get off mid-wave. That's not going to feel good, because sometimes if you get off and you think it's an 8-foot wave, but the data is saying money is coming in, to me, I think that's like the bonus level. You got to stay with that. That's where you rack up all the points. That's where your account is growing. But whenever that gas pedal starts to release a little bit, and you can see it in the data, you can see the level of buying slow. When you start to see that, that's when we come out with our narrative. And then, we write blog posts once a week on our website. And right about that time that we put out that piece about, buyer beware, we put a piece out there where we talked about record breakers. And basically, all it is a duck test, right? Duck test is, basically saying that if it looks like a duck, swims like a duck, quacks like a duck, probably a duck. Well, we could basically say that about the market, right? Because buying is off the charts in stocks. Buying is off the charts in ETFs. The velocity of buying is off the charts. So if all of those things are pointing to, I can't find a bullish case. You can look in the data. I couldn't find it. I mean, I sit there, I scratch my head. I just couldn't come up with a narrative. And so at that point, you have to be reasonable and you have to say, well, the data suggests we're going to have a pullback. And we were days ahead of the sell-off. And that's how we do it. Hopefully that answers your question.
No, it definitely does. Definitely does. I'm curious of your clients, because in our business, especially in newsletters and all businesses and everything in life, people love a story. And if you look at the biggest followings, whether you're way left or way right, whether you watch Fox Business, CNN, they always have a narrative. And even like a good example would be gold bugs. No matter what market is, buy gold, you got to buy gold no matter what. They don't care. But the fact that you're able to switch back and forth, right? Is it hard to retain clients, or that people say, hey, you just told me I was bullish and now you're big? Do they understand this is trading and this is what you look at? There's no feelings involved. This is a system that's working for you. But I got to think that's kind of hard for mom and pop investors who love a great story, because it's not about the story, it's about the data. And you do make it interesting with your charts too, that you actually post on the site and you've been using for our site. But I'm just curious about that part where, do you get any heat from clients where you're very bullish, and then it could be a couple of weeks later very bearish, but they basically have to be really on top of everything that you're saying?
If I look at all the feedback and I look at every comment that comes across, it's overwhelmingly positive. So I feel like people are getting our message. We stay with our message, and it's not a lot of changing our positioning, because like I said earlier, our stance for bullishness usually lasts as long as the money is going in. So it's not like you see a huge spike of money going into stocks and then it just dries up. It just doesn't work that way. That's the thing is, whenever these big funds, these big firms, they got to put money to work, it's going to happen over weeks and weeks and weeks. And that, of course, is going to be lifting the market. So it's definitely not changing the narrative that often. But, if you could say that we expected lower prices, mid-February all the way down to mid-March, which was a month of bearishness. And obviously that was, the pandemic. To flip bullish at that point, we got a lot of negative. I mean, that was the other thing is, you got a lot of people who are watching the news. They're watching the death. They're watching reality. And what's happening under the surface, they can't see. But, we have a pretty good gauge of this. And we're, coming out saying, buy this market. And it caught a lot of people off guard. And we did get some negative feedback. But you know what? They eventually come around, because you can't fight the money. Is basically the narrative. So hopefully that answers your questions. Definitely, we got some negative feedback about flipping bullish at the tail end of March, the middle of March. That was right around our last call. But as of right now, shifting from being massively overbought, saying, hey, we see near-term downside, overwhelmingly, it seems like whoever's consuming our research, they're kind of seeing the market the way we do.
Yeah, which is great, right? Because when you have a track record, they trust you. But even for me, I always say that whenever I recommend something, the thing that I hate, it was my subscribers all email me and say, wow, that's a great idea. I love it. I'm like, oh, no. I love the fact when it's like, you're crazy, don't recommend it, because the negativity for me, it really lets me know that I'm being a contrarian, and that most of the time I'm going to be right on that when I get those negative emails, which I'm sure you could understand too, right?
Well, how does the saying go? If the stock goes down, it's your idea. If the stock goes up, it's my idea.
Yeah, pretty much, yeah. So, but yeah, for me, when it comes to sentiment and your subscribers, the people that listen to you, yeah, for me, I love when I'm recommending something where people are like, are you crazy? It usually means that it'll be right more times than wrong. But I want you to get into really quick. How can average investors track some of this stuff? Because you have research that I know you pay a lot of money for. I do as well. And people subscribe to our stuff because of this data. But, like the big money stock signals, I know some things you can find on your Mapsignals website, the big money ETF buying gauge. Those are two of the things that really showed everyone when you wrote on June 8th on our site. I mean, guys, you can read that on CurzioResearch.com. It's for free. I'm just, giving Luke a lot of credit here. He deserves it. Where you said bottom line level of buying in stocks and ETFs is staggering. It also likely won't last. Looking back, record-breaking buying days like Friday, which you talked about June 5th, tend to forecast lower market returns in near term. So I'm quoting you right from what you wrote on our website. 5 days later, the Dow fell 1,800 points. How could they track this gauge? Do they need like a Mapsignals to do that? Or could they, again, it's more detailed what you're doing than just looking at a regular gauge. It's going to be for free. But I also like to see, provide them alternatives that they could find on themselves also that they could track some of this stuff and learn.
Yeah, definitely. I mean, right now, all of these signals are going to be found on Mapsignals.com. They can definitely get some updates by following your site as well, as we'll publish, a weekly piece or something. But they could sign up. There's different subscription levels, and as it stands right now, we'll basically be narrating what we're seeing under the hood of the market, if you will. We're basically narrating where the market's going, where the money's going, all of that, and what we expect to have by some point this year, so in 2020, is having a login functionality where people can actually go in and create their own experience, basically be able to manipulate the data, go in and start to create these charts themselves. Whatever, if they're looking for the big money index, if they're looking for the big money ETF index, sector indexes, whatever, they basically would be able to get instant access and create some of the analysis that I'm doing every day.
Yeah, no, that's great stuff. And let's put this to the test too, because it's not just the market you look at. I'm sure you're looking at sectors as well, because when I see real estate, industrials, especially industrials, last 6 weeks, there's some massive outflows. Very little buying, and real estate's same thing, but the last 2 weeks been coming back, which makes sense, right? We have mortgage rates near record lows, and coupled with a $1 trillion infrastructure plan coming, that's likely going to pass through Congress. But would you look at something like industrials or different sectors, or maybe share ideas that you like? Because it's not just looking at the overall market, right? It's you can look at sectors really to figure out, what you're going to turn based on the ETF buying, right?
Yeah. So we have these sector charts that are pretty unique. And what they do is they measure the velocity of buying and also the velocity of selling. And so as you can imagine, whenever the markets are overbought, just about every sector is seeing this huge wave of buying. And so we basically smooth out all that noise, all that information into a nice moving average. And basically, you can find this on our website, but essentially, we're basically near peak levels or historical peak levels. And what that basically says is that buying is so big right now that there's only one way for it to go. And that's that it's going to have to slow. And then, that's really the flow of money. It's buying is huge, then it starts to slow, selling starts to pick up, fear starts to pick up, and then all of a sudden sellers get into control. But that's what we're doing. We're looking at the stock level. That's part of our research, and that's really what we started to do as a firm. Is we wanted to be great stock pickers. We wanted to find where's the big money going for great stocks, and a great example would be NVIDIA, right? That one has had tons of big money that just keeps plowing into these stocks. And so over time, as we started collecting more and more of this data, we started to see these patterns that not only is money going into these great stocks, it's also going into these sectors. And if you can look at how all the sectors moving in a basically in a flow and a stream, you start to see extreme points. And those extreme points basically tell you that it's going to be really hard to keep this level of buying up. And so therefore, we're probably going to pull back.
So is that your forecast right now? Because I know my audience always loves ideas, but where do you think the market's heading? Because you did have that 6% pullback, but we also saw positive news. If you could say positive news on retail, of course, it's going to be better than last month because the economy is opening up. Of course, you're going to see better data with housing as well. The market is opening up, but also, the possibility of a steroid helping out in terms of if you have severe cases of COVID-19. But how do you feel now with the markets? Was that enough of a sell-off? You think it's coming down? And maybe if you could share a couple of ideas with us on the short or long side.
Yeah, definitely. Just to think about where we are in the stream of things, we are still extremely overbought by every measure that we have, right? So I think that the market is going to have to pull back eventually. Could we keep going? Could we go to, S&P 4,000? Anything's possible, right? But based on the evidence, right, everything is pointing to a pullback in markets. And so if I had to pick a level, I don't know where that's going to be. That could be 2,900, that could be 2,800, whatever the case is. But one thing is certain is that the level of buying isn't going to keep up like this forever. And so I know the Fed came out a couple of days ago, talked about some of the new asset purchases. We got a lot of feedback from our subscribers asking, does this change? Even a couple people came and they said, will we always be overbought, Luke? Is the Fed just going to buy everything until infinity? And I had to tell them, no, no, but, people are new and they don't know, they don't know what to expect. And so they're reading these headlines and, if it was me, based on the evidence, people coming in to buy the market right now after that 6% dip, it kind of reminds me of how Janet Jackson put it. It's like a moth to a flame burned by desire. So I think we've got some lower levels. It's all based on data, all based on evidence, has nothing to do with fear mongering or anything like that. Any pullback, use that to buy these outlier stocks, phenomenal stocks, because when the money comes back in, they're going to race these great stocks higher.
Okay, so two things. One, I want to say that when you're saying, well, people don't know, I don't know either, because I never thought, I've been doing this for a long time, that we're at 13 times more in terms of stimulus and spending by the government compared to 2008 already, and more is coming, right? So for me, I'm caught off guard where they're even bailing out, risky companies now. So you're looking at that they're buying, junk debt, right? So, yeah, it is pretty crazy of how much it could happen. But like you said, it's not going to be like that forever. And eventually, they're going to stop. But that is an interesting question. Are we always going to be overvalued? Because, it looks like we're in a government that said, Powell just said, hey, we're not worried about the balance sheet, which I couldn't believe he actually said that, which is over $7 billion now. So it is pretty crazy. But I can see that I get that question asked to me as well. I'm like, I have to unlearn a few things here because Shopify trading at 5,000 times forward earnings, right? Yeah.
And it wasn't, just retail people that were asking these questions. These are people who are professionals. And, and they ask these, and I believe they're serious questions. But, the pullback that I'm talking about is technical in nature. It's basically just everybody's on one side of the boat. And typically whenever they do, things, tend to flip around really fast. And that's what we're talking about is it's just going to take one piece of news. It's going to take one piece of unexpected news. Who knows what it is that's going to, really trigger something. And that's what this data is really indicating. It's just saying that, we're at this place that if something negative were to transpire, people jumped on it, we could flip really fast into sellers taking control. And that's really it.
So sellers control, I love that. Now, what would be the best way to play it? Where is it? You see the S&P 500, as well as I do, when markets come down, it's usually the most risky names, which we're actually seeing right now, right? A lot of the cruise lines and airlines are really starting to pull back off their highs of last week. But is it is the play to short Russell 2000, short the overall markets, or buy an ETF, a put? I mean, what would be the right play if your forecast comes to fruition and we see like another 7, 8, 9% pullback, whatever it is? What's the best way to play? Is it small caps, or is this, hey, let me buy a inverse ETF at S&P 500 or something?
Well, first of all, definitely nothing inverse or anything like that. I don't believe in some of these levered products. But, what I would do is I'd be focused on getting your buy list ready. We're about to hit the summer months here. Typically, a lot of traders go on vacation. Liquidity dries up a little bit. That may not be the case here with the environment that we are, but start getting your list ready of, what stocks do you want on? Which ones were you left out on, right? And those are the questions. And whenever that big money index, whenever it starts to fall, that's exactly whenever you need to start making your bet, because eventually it will fall. And then that's whenever you can use it to your advantage, because when people have to sell due to fear, due to whatever, you're going to be in a great position to pick up some great stocks that are going to bounce like fresh tennis balls.
That sounds good. Well, Luke, I want to say thanks so much for writing for us. You're one of the few. The only way I would do that is if someone can provide value that we're not providing. Because we have access to so many people. I've been doing this podcast for over 12 years now. And thank you so much for helping my subscribers, helping my base, and writing for us. And if someone wants to find out more information about you, how could they do that?
Yeah, thanks for having me, Frank. I really like all the stuff that you're doing. I really like this podcast. I enjoy the guests that you have. If people want to find out more about us, they can just go to Mapsignals.com. We have subscriptions for any level of investor or trader. And also we have a free blog that they can follow. So if they don't want to spend money, just sign up for it. You'll see some really unique insights.
All right. Sounds good. Listen, thanks again for coming on. And hopefully, now that you're writing for us, you'll definitely join us again soon. I'll talk to you soon, buddy.
Thanks, Frank. Bye.